Assalamu alaikum. Welcome to lecture 17 of ATX. From 17 onwards till 22, we will be focusing on a new type of tax, that is corporation tax. And corporation tax is for companies. So, the three types of taxes that we have studied earlier, income tax, CGT, IHT, focuses on individual. Now we are moving on to companies. So, whatever we have studied for individual applies for companies as well, because there are some similarities, of course, how you prepare the taxes and all, the rates, but with some differences, of course, because it's companies might get some additional exemptions, some additional rules. So now 17, 18, 19, 20, 21, and 22 focuses on corporation tax. So let's start with a new tax, chapter 17. Now here we are going to focus on corporation tax computation, corporation tax liability, payment of tax, self-assessment for companies, penalties, and summary. In this, we don't have much of a new things. It's just like your revision of corporation tax, but the upcoming lectures will be focusing on the new aspect of corporation tax, which is new in ATX. So now, we are going to go through accounting periods, very important for corporation tax. In fact, any tax accounting periods is very important, but it's more for corporation tax. Calculation of liability and administration. The reason, because companies might not prepare their tax returns, their accounting periods in the tax period. It could differ. Then we calculate liability and administration part. Now, so this and the following two lectures deal with the way in which companies are subject to corporation tax. This lecture sets out the basis of assessment and explains how a company's corporation tax is calculated. Much of this lecture is a revision of tax. Effective communication to clients of corporation tax payment days, filing requirements, penalties are very important, because they might test this. Okay, it might come as a professional skill in ATX. Now, corporation tax computation. So what is the basis of assessment? For corporation tax, all the UK resident companies are assessed to corporation tax. See, this is companies, okay? You have to be a UK resident. UK resident companies are assessed to corporation tax on their taxable total profit. What is it? Taxable total profit. See, every tax is a new term on which we put the tax. Like for inheritance, we had taxable state. For CTT, we had chargeable gain. Then for income tax, we had taxable income. Taxable gain we had for CGT. So likewise for corporation, we know we have taxable total profit, which arises in the accounting period AP. So whenever I say TTP, it is taxable total profit. Whenever I say AP, it's accounting profit. Now, this TTP is all your income, excluding the dividend received. Dividend received will not be taken into account, plus your net chargeable gains, less qualifying charitable donation. This qualifying charitable donation we have covered in income tax. When we studied income tax, we finished qualifying charitable donations. I'm not going to put more effort to explain that. Okay, you can go back and see what is qualifying charitable donation, how it works. The rules are same. Now, accounting period. The accounting period is a period for which a charge to corporation tax is made. That means for this period, whatever your profit will be charged to corporation tax. Usually accounting period is 12 months, and it will be the same as the company's period of account also, because normally companies prepare their accounts for 12 months only. But it can be less than 12 months, but it cannot exceed 12 months. Note that a company's period of account is the period for which the company prepares its financial statements. It's usually 12 months, but can be shorter or longer than 12 months. In the exam, the term accounting reference date will be used to describe the date to which the company's financial statements are prepared, otherwise known as the accounting date. Whether it's accounting reference date or accounting date is the same. Now, if the accounting period exists 12 months, you have to split the corporation tax accounting periods into two parts. There will be two corporation tax. First tax will be on the first 12 months of the period of account. The next will be on the remainder. Usually it's the short accounting period. It will be less than 12 months. 12, let's say 12 months and 6. Or let's say you have prepared the accounts for 18 months. So first 12 months and the remaining 6 months. Or let's say for 14 months. So first 12 months and the remaining 2 months. Okay. And accounting period starts when a company starts to trade or when the profit of the company first becomes liable to corporation tax or the previous accounting period ends. Starting is very important. You have to know when an accounting period starts and ends, because in that accounting period you will charge the corporation tax. If your accounting period gets wrong, corporation tax gets wrong. Now, a new company, they must notify HMRC that they must notify HMRC of establishment within 3 months of the start of its first accounting period. Within 3 months, there's a separate obligation to notify HMRC of chargeability to tax within 12 months from the end of its accounting period. An accounting period ends on the earliest of 12 months after it started, the end of the period of account, when the company ceases to trade, okay, or when the company ceases to be UK resident, or when the company ceases to be liable to corporation tax, or when they cease the administration or there's a winding up proceedings. Whichever of this four is the earliest, that time your accounting period ends. Now let's do question. Illustration 1. So here, state the dates of Elders Limited first two accounting periods. Started incorporating on 15 July 2023. Okay, was incorporated on this date. Started to trade on 1st September 2023. Company chose 30th June as its accounting reference date and prepared its first financial statement to 30th June 2024. And then for the 12 months, from that means from 30th June 2024 onwards, it's normal 12 months. Every year 30th June. Okay, so first accounting period will be 12 months. That is, see, accounting period always starts when you start to trade, and you started to trade on 1st September 2023, not when you incorporated, till 30th June. 30th June. This will be our first AP. So you see it's less than 12 months. It is from the date of commencing date until the end of the period of account. That's your first AP. Second AP is normal. 1st of July 2024 to 30th June 2025. So one day after this date, immediately after the end of the previous AP until the accounting reference date. And AP does not start on the incorporation of the company. This you have to know. It starts when you start to trade. Now, illustration 2. State the accounting periods for which, if it is prepared, one set of financial accounts covering 16 months to 30th April 2025 or two sets covering 4 months to 30th April and 12 months to 30th April. Okay, so if according to the first one, see, Fly has been training for many years, preparing its financial statements 31st December each year. The board of directors have to take the accounting reference date to 30th April. Okay, so if they are making one set of financial statement covering 16 months, remember the 16 first 12 and then the remaining 4. So 12-month accounting period to 31st December 2024 and then till April. Then it's 4 months to 30th April 2025. It will be divided like this. And in the second one, it's two set of financial statements. So the AP will be the same as a financial statement because they have changed the date from December to April. So it's April and April. No issue. 4 months to 30th April 2024, 12 months to 30th April 2025. So this AP will be same as a financial statement. There is no issue in the second one. Now illustration 3. Accounting periods on cessation when you are ceasing. State the dates on wise accounting periods from 1st July 2022 onwards. Okay. So while Limited has been trading for many years with the 30th June accounting, due to financial difficulties, they decided to wind up. Ceased trading on 31st December 2022. And on 30th April 2023, the winding up commenced. The winding up was completed on 31st March 2024. That means up till this date you have to write. Okay. So it is from 1st July. You see, accounting reference date was June. So we'll take from 1st July 2022 to 31st December, this date, when they cease trading. Next, then is the next date, 1st of Jan to 30th April. And the next one is from the winding up was completed on 31st March. So 1st of May, that is next day from this day till 31st March 2024. Okay. The company's normal 30th June year end is ignored during the winding up process. Okay. During winding up process, normal year end is ignored. Now, so we are going to go through the pro forma of corporation tax computation. Learn the pro forma of any tax, income, CGT, corporation, VAT, inheritance. It's very important. Pro forma will help you to do your calculations faster in your exam. So here, first you write the name of a company, then the corporation tax computation. You have to write which type of tax you're calculating. Always corporation tax, income tax, what tax. So if it's corporation tax, write corporation tax computation. For the AP end date, write the accounting period end date. Very important. Then you start with the trading profit. We'll go in detail in each of these items, but first let's go through the pro forma in general. Okay, trading profit. We add all the types of other profit like interest income, property income, then miscellaneous income, net chargeable gains, and you get your total profit. From here you deduct your QCD. It has to be the gross amount. They will give you in the exam what is the QCD. Then taxable total profit. On this you will charge that corporation tax at relevant rates. We'll see what are the relevant rates. Then you deduct the marginal relief if it's applicable. We'll see what marginal relief it is. Then you get your corporation tax liability. From there you deduct double taxation relief. Now double taxation relief we have studied in inheritance tax. From quick succession relief we deduct DTR. Here it's not, we don't have QSR, we just have double DTR. Then we get corporation tax payable. First is liability, we deduct DTR and then payable. Okay. Now, so what is the due date? Due date is for corporation tax, the due date is 9 months. Remember, these dates are very important. Okay, you have to advise your client and you have to write the due dates. 9 months and 1 day after the end of accounting period. If it's a large company, you pay installments. What is the filing date? 12 months after the end of period of account. Then these are some notes relating to the pro forma. So you saw trading profit, interest income, property income. Okay. This includes income from overseas sources as well. And all income is gross. Third, QCDs include all donations to charities by a company, except those allowed as a trading expense that you can't take. Then the detailed rules for calculating TTP are in lecture 18. Now, so you apply the appropriate rate on the company's taxable total profit to get the corporation tax liability. How do you determine the rate? It is determined by comparing a company's augmented profit. Augmented profit. These are new terms you are learning. Okay, company's augmented profit to statutory limits. This is how you calculate augmented profit, and you have to know it. It's a must. TTP plus your dividend received from non-group companies. Non-group companies is augmented profit. Now, dividend received. Although dividends received from UK and overseas companies are exempt from corporation tax, they can have an impact on the rate of tax. Remember, that's why you, for augmented profit, you have to add it to the TDP. Okay. Rate of tax that the company pays, and also whether the corporation tax needs to be paid by installments. For that decision, you need the dividend receipt. You have to take it into account. So the cash dividend are added to the TTP to arrive at augmented profit. Dividend received from an overseas companies are included. but they may have been subject to tax in the overseas country. Any overseas tax suffered is ignored. Accordingly, only the actual cash received is included in this calculation in the same way as UK dividends. So just take overseas as UK dividend. Whatever overseas tax you have suffered, do not take it. Ignore it. Dividend received from associated companies are ignored in the calculation. Now, so the rate of corporation tax is fixed by reference to the financial years. And your financial year, see, do not get confused with this with the individual when we pay income tax. There the tax year runs from 6th April to 5th April. Here for companies, financial year runs from 1st April to 31st March. Do not confuse the individual and the company together. The dates are different. Here, there it was tax year. Here is financial year that runs from 1st April to 31st March. Let's say the year commencing on 1st April 2023 will be taken as financial year 2023. Financial years should not be confused with tax years for personal taxes. Personal taxes for your income tax, CGT, inheritance tax. These were your personal taxes. Okay, which runs from 6th April to 5th April. Now, calculating. So the rates of corporation tax are needed for the ATX exam are this. For 2023, it's 19%. We have what is known as small profits rate. Then we have a main rate. In 2023 is 25%. 122 it was 19%. Then the lower limit is 50,000. Upper limit 250,000. Standard fraction 3 divided by 200. We'll go through this formula, don't worry. So the relevant rate is found by comparing augmented profit to the upper and the lower limit. Can you see 50,000 and 250,000? You see your augmented profit by comparing in this. The limits may need to be adjusted as follows. If it's short accounting period, you have to time a portion, remember. And if it's associated companies are there, let's say you have 5 associated companies, you have to divide the number of associated companies in the group. Let's say 5 associated companies, you have to divide it by 5, the profit, like that. Now, marginal relief. So the marginal relief is available if augmented profits falls between the upper and the lower. This is how you calculate. Upper limit minus augmented into standard fraction, that 3 divided by 200 into TTP divided by augmented profit. Now let us do a question. Illustration 4. So in illustration 4, calculate the corporation tax liability. You have been given the TTP as 150,000 and dividend received from unconnected companies 30,000. So you have to add both TTP and dividend to get augmented 180. This 180, if you see, lower is 50,000, higher is 250,000. This falls between the limits. So that's why there's a marginal relief that applies. Okay. Now, so this is how you calculate the marginal relief. First, calculate corporation tax. It's 180. Okay. So the corporation tax is 25% on 150. It's on TTP. This one. Okay. Now, so because you have a marginal relief, okay, you can see the corporation tax is 25%. So it is the higher minus the augmented standard fraction into the TTP divided by augmented 875. So this is your marginal relief which you will deduct from corporation tax on TTP, and you will get your corporation tax liability. Now, corporation tax liability for short AP. Calculate corporation tax. Here, this is for 9 months only. Earlier, illustration 4, it was for year ended, that means 12 months. So you don't have to time a portion. Here, you have to time a portion for 9 months. Here also is same. You add both, get the augmented is 180. So it's the same. it would be 37,500 only. Only this will change because you have to divide the lower limit and upper limit. You have to take only for 9 months. So now your limit changes. Still, it falls in that limit. So this is the upper limit now, minus augmented standard fraction, your TTP divided by the augmented profit, and you get your corporation tax liability. So whenever you have your marginal relief, corporation tax is 25%. Now, accounting period straddling 31st March. When an accounting period falls in 2 financial years, it happens sometimes. Corporation tax liability must be calculated for each financial year separately. If either of the following changes, the corporation tax rates or statutory limits. Statutory limits and the rates of the corporation tax changed on 1st April 2023. There are two-part computation that is required for AP that is straddling 31st March 2023. So the corporation tax must be calculated separately for each financial year, applying the appropriate rates of tax to each. Now let us do a question. Illustration 6. Here you have to calculate the corporation tax for OBOI. You have been given the TTP and the dividend. So you have to add both and get the augmented profit is between lower or upper. It's more than higher limit. That is 250,000. As you can see, the augmented profits are above the upper limit 250. So you apply the main rate. The main rate is, what is the main rate? You have to follow that table for the main rate. Okay, main rate is 25%. And the small profit limit is 19%. So now 3 months. Remember the year end is 31st December 2023. But out of this, the first 3 months, that is 1st of Jan to 31st March, because this is the accounting period end also, 31st March. So from 1st Jan to 31st March, the 3 months falls in FY 2022. The remaining 9 months falls in FY 2023. Here, the rate was, main rate is 19% in 2022. So that's why we apply 19% in this and 25% in this. Take the months and into the TTP 300,000, not the augmented profit. Don't take augmented profit here. Remember, corporation tax is always on TTP, not augmented profit. Augmented profit we need for the limits, whether we get the marginal relief or not. So you add and you get the corporation tax liability. You have to add separately like this. You can't take 1% and apply to the whole TTP. No, because partly the 3 months falls in the financial year 2022, last 9 months falls in the financial year 2023, and the rates are different. If the rates were same, there would have been no issue, but the rates are different. Now, test understanding 1. Here, calculate corporation tax liability for 31st September 2023. It's the same thing. First 3 months, it will financial year 22. The main rate was 19% and here is 25%. And the remaining 6 months, because this is a 9 month, till September, no? FY is 2023. TTP is 75 and dividend from non-group companies 15,000. So you have to add both and you will get 100,000. If you see 100,000 is between 50 and 250, between the two limits. So you will get a marginal relief here. This is augmented profit. After you add 75 and 15. 75 is the TTP. So what do you do? Just take 75,000 because that is the TTP. This is FY 2022, 2023. Here it's 19%, here is 25%, and wait a minute, there is one uh, one thing. See, this is what I have missed out, and this is what you might missed out. They told calculate for the year ended 31st September 2023, and they are making in the year ended 30th September 2023. Okay, this is not 31st, it's 30th September. Okay. So now, augmented profit is not 100. 75 plus 15 is 90,000. Okay. So it falls between 50 and 250. Now, it's not from 1st of Jan. It's year ended 31st. So the year will start from 1st October. 1st October 2022. So this is what happens when the year goes wrong. When your calculation of the months go wrong, this is what happens. And it's still 31st March. Because till 31st March is the year. This thing, accounting period. So it is 6 months. Okay. I was thinking it's from Jan to September. No. This one was different. Year ended because it was prepared in 1st Jan. It's from 1st Jan to December. This is from September to September. That's why the issue came. Okay. So now, then 1st of April to 30th September. The remaining 6 months. So it's 6 months, 6 months. 1st of April 2023 to 30th September 20. 6 months. So now it is 6 months and 6 months. Okay. 6 months and 6 months. 7125 9375. You add, you have to deduct your marginal relief. How do you get your marginal relief? Marginal relief is the upper limit 250 minus the augmented profit 90,000. See, the more you apply the formula, the more it stays in your head. Standard fraction 3 divided by 200. This is fixed. Into the TTP. TTP is 75,000. Divide by augmented profit 90,000. Into you only have to take for 6 months. Okay. Now it's 1,000. The current year. Okay. So you have to add this 7125. I'm writing it here again 9375. And the total is 15,500. This is the corporation tax liability. Associated companies. What are associated companies? Two companies are associated if one company controls the other or both are controlled by the same person. Could be company or individual. Control. Person having more than 50% of the issue share capital of another company or voting power or right to receive distributable profits or right to receive net assets in the event of a winding up. Examples of situation. So one company controlling the other. Let me explain you this through a diagram. H Limited controlling 100% of S Limited. H and S are both associated. Here, H is taking 70% of S1, 80% of S2, and 51 of S3. So H, S1, S2, S3 are all associated. Now, both are controlled by the same person. This is an example of that situation. Both Y and Z are controlled by X, 170. Okay, so Mr. X is the controlling link. So X, Y, Z, all three are associated. But because Mr. X is an individual, he will not be included in the number of associated companies. It's only Y Limited and Z Limited will be included in the associated companies. Now, Control can be exercised directly or indirectly. H can have direct 51 of S and have the control. This is direct. Or S can have 51 of T. That means H is having an indirect control over T. So both S and T are associates of H. It is not necessary to have an effective interest of greater than 50% for associates. Therefore, it does not matter that H's effective interest in T is only 26%. If you multiply 51 by 51, no, it's 51. Now, so the definition of associated specifically includes, in the associated companies, this will be included: overseas resident companies, subsidiaries joining and leaving during AP, but excludes dormant companies and inactive non-trading holding companies. Now, what are the consequences of associated companies? It affects your upper and lower limit and also your whether you have to pay in installments or not. So upper and lower limits used to determine the appropriate rate of corporation tax are divided by the total number of associated companies during the accounting period. Okay. So now, let's say the 1.5 million threshold. We have not gone through the 1.5 million threshold yet. I will take you through that little while. So there is a 1.5 million threshold. This threshold is used to determine whether the company is large or not for the purpose of paying corporation tax quarterly installments. So therefore, you have to divide. If you are having associated companies, you have to divide the 1.5 by the total number of associated companies at the end of the previous AP. Now, third consequence is dividend received. Any dividend received from associated companies are excluded in the calculation of augmented profit. Associated companies could be from UK or overseas. And a group of companies are entitled to only single annual investment allowance for capital allowance. But the group can choose how they want to allocate the single AI among them. So before we move on to the payment of tax, let us do a question. Test your understanding 2. So in test your understanding 2, you can see Mr. A is having 51 in Z, 65 in A. So they are associated. But Mr. A can't form a part of a company. He's an individual. Then Z is having 100% in Z. This is Inc. Inc means it's overseas. Okay. This is dormant, but having 100%, 60%, 100. So everywhere there's a control and all are associates. This has been sold and this has been acquired on this date. Now, all companies except Z Inc. are UK resident and prepare financial statements to 31st March 2024. A Limited has taxable total profit of 40 for year ended this. Also receives dividends of 5,000 from D in Jan 2024. State which companies are associated. Companies of A, calculate the corporation tax of A for the year ended. Okay, so if you see here, first we'll see the connection of A. So if you see A has 4 associated companies, what are they? Z Limited, Z Inc. and C and D Limited. C and D Limited. 2, 3 and 4. What about A Limited? He's having 65%, then why not A? We'll see. So here is the answer. You see, A Limited has, sorry, this is A Limited I'm talking, I'm sorry. It's A Limited, not Mr. A. A Limited has association of C, D, Z and Z Limited will also come. Not the dormant. Dormant will not fall there. So ZL, Z Inc., C and D. A Limited. Okay. Now, Mr. A controls all of the companies in the diagram, but it will not be included as an associate because he's an individual, not a company. This you have to remember. Z Inc. is an overseas company, even though it is incorporated. It's an associated, even though incorporated overseas. And B will be excluded because it's a dormant. And throughout the counting period, it was dormant. Otherwise, they will write the dates. C and D Limited. If you see C and D, they are not throughout the whole period, they were not associate. This was sold on 30th September 2023. And this was on 1st of December 2023 it was purchased. So this is for 4 months there. And this one till, let's see. So here, they are associated for the whole accounting period, even though they have only been part of the group for 6 months and 4 months respectively. So even though they have been acquired or sold in between, you have to take the whole accounting period that they were associated. So normally you would have done that, but no, you have to take as for the whole. So it's 4. So now you have to divide your threshold by 4 because there are 4 associated. So now we'll calculate. So TTP is 40. Ignore dividends from associated companies. We don't take it. Okay. And A Limited also received dividends of 5,000 from D. So he received 5,000 from D. D is an associated. That's why we are not taking it. Okay. Now, as A Limited has 4 associated companies, the limit must be divided by 5 companies because A is also there. A Limited has 4 associates. So with A there are 5. So lower limit is 50, upper is 250 divided by 5. Now it will change to 10 and 50,000. Augmented profit is 40. It's between these two. So now it's on this date. The main date is 25%. On 40,000, that is on TTP. Your TTP is also 40,000. Augmented profit is also 40,000. Okay. So now corporation tax is 10,000. You will get a marginal relief because augmented profit falls between upper and lower. So this is the upper limit 50,000. This new upper limit you have to take, not 250, minus augmented into 3 divided by 20. What about the other remaining part? It will have no impact. Why? Your TTP is 40,000, augmented is 40,000, so 40 divided by 40 is 1 only. No impact. It's 150, and this is your corporation tax liability. Next is the payment of tax. So the due date depends on the size of the company. For companies which are not large, due date is 9 months and 1 day after the end of the AP. For large companies, quarterly installment starting during the accounting period. All companies must pay their corporation tax electronically. What is the definition of a large company? A large company is whose augmented profit for the accounting period are more than the profit threshold of 1.5 million, but not more than 20 million. A company with augmented profit exceeding 20 billion is a very large company, and that is not tested in your ATX syllabus because the payment arrangements for these companies are different. They will not be asked in ATX, so don't worry. You will never be given the profit more than 20 million. Companies with augmented profit of no more than 1.5 are not large, and therefore they do not pay their corporation tax by installments. They pay by 9 months and 1 day. It is just as simple as that. Less than 1.5 or more than 1.5 million threshold, you have to check that. So the 1.5 million threshold may need to be adjusted in the same way as the upper and the lower limit for corporation tax. If it's short AP, you have to take the number of months. And if it's associated profit, then also you have to divide the total number of associated profit. That means 1.5 million threshold will be divided by 5 if there are 5 associated companies. Now let us do a question. Test your understanding 3. Calculate the CT liability and state when it will be payable. That means corporation tax liability and when it will be payable. So you have been given for 9 months ending 31st March 2024. TTP is 30, dividends received from non-group companies is 2000. Okay. So you add the 30,000 and 2,000 for the augmented profit. This is your augmented profit, 32. Whether it falls between upper and lower limit, you have to take for the 9 months. You have to apportion. So the upper limit, UP, and the lower limit, lower limit, upper limit. 50,000 you have to take for 9 months. 250,000 you have to take for 9 months, which is 37,500, 187,500. This one is less than the lower limit also. So you will not get marginal relief. Okay. Because augmented profit are below the lower limit, you will be paying tax at 19%. That is the small profit rate. Okay. That is 19%. So 19% on 30,000. That is your TTP, not augmented profit. 5,700. And now, even the threshold of 1.5 million will be limited by 9 months. So you have to take for 9 months, which will be 1.125 million. So if you see, your augmented profit is below this threshold. It is just 32,000. Just 32,000, much less than 1.125. So that's why your due date is not by installments. You are not a large company. It will not be by installments. It's 9 months, 1 day after the end of the accounting period. So 31st March, 9 months, 1 day. So 9 months from 31st March, it is 31st December and 1 day after. So 1st Jan 2025 is your due date. 9 months, 1 day. Okay. And one more thing that I've missed out, which is very important, is your financial year. Whether everything falls in 1 or 2 separate years. In this case, thankfully, everything is in 2023. Everything falls. Just see, 9 months ending 31st March 2024. It's after 31st March 2023 only. 9 months from then. So everything is in one financial year. So all your accounting period falls in your augmented profit will fall in the financial year 2023. So one rate you can use. Next is quarterly installments for large companies. Installments paid by large companies are based on expected corporation tax liability for the current accounting period. Therefore, it is necessary for companies to prepare an forecast of their current period tax liability. Companies will normally be able to obtain a refund if they have overpaid in their installments. Interest will be charged or paid based on the actual corporation tax due per the final tax return. For a 12-month accounting period, there are 4 quarterly installments that are due by the 14th day of month 7, 10, 13 and 16 following the start of the accounting period. This date, this month, how many installments for a specific accounting period you should know. Because if accounting period is less, quarterly installment will be less, months will be different. But there is an exception to these installments for large companies. Large companies which do not have to pay by installments are this: companies whose liability is below 10,000 for the year. If your accounting period is less than 12 months, you have to prorate this 10,000 amount. Companies that have become large during the accounting period, provided they were not large for the previous accounting period, but this year they became large and their augmented profit do not exceed 10 million. And if you have short accounting period or if you have associated companies, remember this 10 million threshold will be reduced. Okay. So based on that, your accounting profit do not exceed that, and you are not large in the previous year, but currently you are large, the current period, you don't have to pay by installments. Now let us do a question. Test your understanding 4. So you have part A and B. Calculate corporation tax liability for year ended 31st October 2023 and 31st October 2024. Explain how they will be paid. Assume you are writing in June 2024 and that the FY 2023 rates apply throughout. B. July 2024, company revises its focused taxable TP to be 2,006,40,000. State the differences, if any, this will make to the corporation tax payment. Okay. So this is a single company, no associated companies. On 1st Feb 2024, estimated TTP will be 2.4 million for year ended 31st October 2024. Its TTP for the year ended 31st October 2023 was 1.7 and for year ended 31st October 2022 was 1.2. Okay, so now we'll calculate first one. See, we can calculate based on 1.7 and based on the forecasted. We want for 2023 and 2024. We don't want 2022 corporation tax. So for 2023, it will be on this 1.7 million. What rate? 25% rate. Okay, because FY 2023 rates will apply. And also 25% on this one for these two dates. So we got the corporation tax 425 and 600. Now payment dates. Okay, there are two things you have to do. One is for this year ended, what would be the payment date? One is for this year ended 2024, what is the payment date? As you can see, this is 9 months 1 day. We'll see why. And this is in installments, that's why installments are calculated. Maybe it was large. So we'll see. Okay, we have to see the 1.5 million threshold. Okay, so you can see, because no dividend received, your TTP will be equal to your augmented profit. Okay, and if you see, it is 1.7 million. It's more than 1.5. Wait up. Sorry, you have to take the previous year. For this year, you have to take the previous year's TTP. So 2022, it was 1.2 million. It's less than 1.5 billion. It was less than the 1.5 billion. So company was not large, so they have to pay 9 months 1 day. They are not large. And in this year, they are large because it is exiting the 1.5. But they don't have to pay the quarterly installment because in the previous year, they were not large. This falls under that exception, first exception, that because in the previous year they were not large. Okay, so they can pay 9 months 1 day. Okay, so this liability, this corporation tax will be paid 9 months 1 day from this date onwards, which is 1st August 2024. Because if you take from October, November, December, January, February, March, April, May, June, July, 31st July and 1 day after 1st August 2024. Coming to the next year. Here, you see both the years is large. Augmented profit. Here, it exists. Previous year also it was 1.7 and this year it's 2.4. So in both the years they were large. Okay. So it has to pay the 600 corporation tax in quarterly installments. Remember, it's 14, 14, 14, 14. So starting from the 7th month. Okay. 7 month, and because it's a year, 12 months. So there are 4 quarterly installments: 7 month, 10 month, 13th month, and 16th month. And it's equal installments. Okay. So 600 divided by 4. That's why it's 150,000. The only thing is we have to find out the months. If you find the first month correctly, Just add 3 more months to each. Like from May, it's June, July, August. Then from August, September, October, November. And then from November, December, January, February. Like that. The only thing is this month. If you get it correct, rest everything you get correct. It's a 7 month. 7 month from when? See, it's year ended 31st October. That means from 1st November to 31st October. This is the year, right? So from 1st November, you have to take 7 month. November is the first month. November, December, January, February, March, April, May. So when you land from November to May, May is the 7th month. November is the first month. November, December, January, February, March, April, May. May is the 7th month. Take the 14th of it. So that's how we got 14th May, and just keep on adding 3 months to each. May, June, July, August. So August. Then from August, September, October. So in between each month, there will be 2 months remaining. So from May to August, June, July. From August to November, September, October. Then from November to February, December, January. Like that. In between, you can see there are only 2 months left. And it's equal installments. Okay. So 7 month means from the start of the accounting period. That is from 1st of November, you have to go 7 months, including the first month. Now, part B. If TTP was revised to 2.6 million, state the differences. Which date? Okay. So here, if the profit is revised upwards, tax payments also will be revised. Corporation tax will increase to this much. And there will be quarterly payments because then also it's a large. Okay. So on this, you pay 25%. This is your corporation tax, 660. So the 660 divide by 4 to find the quarterly installments. Okay. So how much you have to pay? Currently, how much you are paying installments? 150, no? See here, you have to go upwards. You are paying 150 each. Now you have to pay 165. So the extra 15 you have to pay for each installment. Okay. So as the installment for the May has already been paid. Okay. The additional 15,000 will attract interest from 14 May 2024 until it is paid. Okay. You have to pay additional, you didn't pay, that's why you are attracting interest. Now you have to pay with the interest. So this will run from 14 May 2024 until it is paid. Okay. Short accounting periods for large companies where the period is less than 12 months. First installment due will be by 14th day of the 7th month after the start of AP. This is normal. Next, then the subsequent installments are due at 3 monthly intervals thereafter until the date of the last installment is reached. Last installment is due by 14th day of the 4th month after the end of the accounting period. That falls after the end of the accounting period. Okay. Now, for an accounting period of 3 months or less, applying the installment rule would result in the date of the first installment being later than the last installment. Therefore, in this situation, the full tax due for the accounting period is due on the date of the last installment. That is the 14th day of the 4th month after the end of the accounting period. Only one installment is there. Amount of each installment is your corporation tax into N divided by length of AP, where N is 3 months for a full quarterly installment and N could be 2 or 1. for the last installment if the period since the previous installment is less than 3 months. Now let us do the last question of this lecture. Illustration 7, the last question of this lecture. Here we have to find the installment amount and the due dates when the accounting period is less than 12 months. So here it has been prepared for 8 months. Corporation liability is 800. You have to show when they will be due. Okay, so because this is 8 months, which is less than 12 months, we'll follow the formula. So corporation tax into N. They have told N is 3 if it is quarterly installments. Okay, full quarter installments. So it's 3 divided by length of the accounting period. So accounting period here is 8 months. So it's 8. So it's 300,000. Okay. The first 2 installments, there is no issue. It will not be equal to 4 installments. There will be less than that. Okay. So you have to start from the 8th month ending 31st December. So when does it start? When does the AP starts? Accounting period starts. It starts from May. May to December. May, June, July, August, September, October, November, December. Right? So you have to take 7 months from May. 7th month. So May, June, July, August, September, October, November. Hence 14th of November. So we got our payment and we got the date. Add 3 months to it. That is the 10th month. So 10th month will be December, January, Feb. So another 300, 14th. But we can't pay another 300, okay? Because then it will add up to 900. The total is 800, okay? So for the last installment, what you have to do is it's 800 into 2 divided by 8. You have to write N could be 2 or 1 if it can't be 3 because you can't pay exactly after 3 months. Why? It should fall on the 10th month. 7, 10 and 13th month. If it falls in the 13th month. So from Feb, March, April, May. So it will fall on 14th May, right? It can't fall on 14th May. Why? Because the accounting period starts from 1st May. It falls after the accounting period year ends. So that's why it's 14th April, 1 month before. So from Feb, March, April. So it's just 2 months. So 2 divided by 8. It is not full 3 months, it is 2 months. So this N will change to 2 from 3. So which is 200,000. That's how we get this figure. Try it yourself and check. So it can't be 14th May. If you go by the normal rule, which is for 12 months. Yes, it's 14th November. Next payment is 14th Feb. These two are okay. But if it's 14th March, April, May, 14th May, it falls after 1st May, after the accounting period. So it can't be like that. Okay, that's it. So now the interest part. The good thing is the interest part is very interesting. it's very easy. Okay, so whenever you are paying late, like any other tax, CGT, IST, income, for corporation also, we have some interest, late payment interest. This runs from the normal due date on any tax paid late to the date of actual payment. And this interest will be deducted from the interest income in the corporation tax computation. Any repayment of tax will also attract interest from the later of the day after the original due date or actual date of payment, whichever is later. From that date onwards till the repayment of the tax, you will keep on attracting interest. Now, so from the date of later of this to the date of repayment, this interest is taxable. Remember that interest that you are getting on the repayment of tax, that is taxable, and it will be included in the interest income in the corporation tax computation. Now, group payment. Group payments are available for associated companies. where at least one group company pays corporation tax by quarterly installments. The effect is this: one group company will pay on behalf of the whole group. Okay, they will pay quarterly installments of the corporation tax. What happens because of this? This saves tax. Sorry, this save interest, because overpayments will be netted off against underpayments. So without this group payment arrangement, interest charge on underpayment is likely to be more than the interest received on overpayments. That means you are paying more interest. So you can save interest through group arrangement. However, each company must still prepare their separate corporation tax computation at the end of accounting period, because you might anytime leave the group or join the group, so always you have to keep it prepared. Now, what is the impact of taxation on the cash flow of a business? Companies need to take account of their tax payment when they are considering their cash flow forecast. So whether they want to pay early, whether they want to delay the payment, depends on their cash flow forecast. So this will be a particular problem when the company changes to quarterly installment for the first time. Let's say they are a small company. They were paying 9 months one day. Now they are suddenly becoming big company. Now they have to pay quarterly installments. So for the first time when they are paying it, there's a problem with it. So that's why you have to take this into consideration and see the impact of cash flow. Next, self-assessment for companies. So we have done with payment of tax. Now we are moving on to the self-assessment for companies. How we do self-assessment for individuals under income tax or CGT. Same for this. So as for individual self-assessment policies for corporate taxpayers, responsibility rests with whom? Company. They have to calculate their own corporation tax liability. They have to submit within 12 months a self-assessment corporation tax return after the end of the period of account. They have to pay any corporation tax within 9 months one day after the end of accounting period or under quarterly installment system. So given the timing of the due date for payment of tax, many companies will aim to complete the self-assessment tax return before the normal 9-month deadline for paying the corporation tax, so that they can pay an accurate tax and avoid interest charges on underpaid tax. Okay, they will do this self-assessment tax return before that 9-month one day deadline. Before that, they will do the self-assessment tax return, so that they pay accurate tax. They can avoid interest on underpayment tax. Now, you have to notify of the chargeability within 3 months from the first accounting period. That means this is the first time when you are charged to corporation tax, you have to notify that you are chargeable to it. First time when you are charged to corporation tax, and the time is within 3 months. Companies that do not receive to notice a filed a corporation tax return are required to notify HMRC if they have any income or chargeable gains on which tax is due. Even if they don't receive that tax return, okay, the notice to file a tax return, they have to notify HMRC that they are chargeable to income or chargeable gain. And the time limit is 12 months from the end of accounting period in which that liability arises. A standard penalty may be imposed for failure to notify HMRC that you are chargeable. Now, so the form is CT600. You don't have to remember the form and all. Okay, the self-assessment tax return, the name of the form is CT600. This must be submitted by the later of 12 months after the end of accounting period or 3 months after the issue of notice to file a return. The return must contain all the information to calculate the TTP of the company. It should include the amount of corporation tax payable. It should be submitted online. A company has to submit a copy of his financial accounts together with the self-assessment tax return. Okay, both financial account as well as self-assessment tax return, because they might want to see your financial accounts to know whether your tax return is correct or not. Now, so corporation tax return due date is the later of 12 months after the end of accounting period and 3 months after issue of notice, and file online. If return is incomplete or file late, penalties arise. Contents includes calculation of tax due, copy of financial statement, claims for reliefs. These 3 things are there in your corporation tax return. And you can amend your return. So amendments to return can be made within 12 months from the filing date. Now, determination assessment. To prevent companies deliberately delaying the submission of their return, what HMRC has done? They have done the following actions. HMRC will determine the corporation tax due. They will determine the amount now by issuing a determination assessment. So the determination assessment is treated as a self-assessment by the company, and it will be replaced by the actual self-assessment when it is submitted by the company. There is no right of appeal. You can't appeal against a determination assessment. Instead, the company must displace it with the actual self-assessment return. Determination can be raised by HMRC at any time within 3 years of the filing date. That means 4 years from the end of the period of account. Records. Companies have to keep and preserve their records, and the records must be kept for all expenses and receipts, all goods purchased and sold, all supporting documents relating to accounts, books, contracts, receipts. You have to keep records. They must be retained until the later of 6 years. These dates are very important. Very, very important, okay? You need it when you have to advise your client. So the record must be retained until the later of 6 years after the end of accounting period to which they relate. Until 6 years, you have to keep the record. The date on which a compliance, if you are having a compliance check, then the later of it. Okay, the date on which a compliance check into the return is completed. Until the compliance check is not completed, you can't discard your record. The date on which it becomes impossible for a compliance check to be started. Whichever of these three events is later, till that date, record must be retained. If you don't, there will be a penalty. Maximum penalty is likely to be imposed in most serious cases. For example, where companies deliberately destroying their records. Now, amendments to the return. You can make amendments to the return within 9 months of the date the return is filed. 9 months. So HMRC can correct any errors or mistakes within 9 months. They can correct arithmetical errors. They can correct errors of principle. Okay, remember, even if HMRC has corrected for you, does not mean HMRC has accepted the return as accurate. Company can amend that. See, if HMRC corrects the mistake, it's within 9 months. If company amends their return, it's within 12 months. More 3 months is given for the company. So let's say an AP is ending 31st March 2024. Filing date is 12 months after that. That is 31st March 2025. That means company can make amendments up to 31st March 2026, another 1 year from the filing date. If error is discovered at a later date, company can make a claim for overpayment relief to recover any overpayments of corporation tax. Let's say due to some error you have overpaid corporation tax. Now you can get a relief for it. You can claim the relief. Claim for overpayment relief. So let's say assessment is excessive due to an error or mistake. Company can claim relief. Claim can be made in respect of error, okay, or mistakes arising from not understanding the law. This claim must be made within 4 years of the accounting period to which it relates. Compliance checks into returns. HMRC has the right to check the completeness and the accuracy of any self-assessment tax return, and they can issue discovery assessment under their compliance check power, because HMRC has compliance check power if they feel they have to. And these procedures and rules are very similar for those for individuals. So please go back and check what I've done for income tax. Compliance check may result as one of the following. Maybe they are suspicious that income is undeclared. Maybe they are suspicious that deductions are incorrectly claimed. Maybe there are some other information in the hand of HMRC. And it is just a part of random selection process. So any of this event occurs, compliance check might happen. Now, HMRC does not have to state a reason why they want to do the compliance check. Okay? But before doing any compliance check, they have to give a written notice by the following dates. If return is filed on time, the notice must be issued within 12 months of the actual delivery of the tax return to HMRC. If return is filed late, these are the dates. The notice must be issued within 12 months of 31st Jan, 30th April, 31st July or 31st October next following the actual date of delivery the tax return to HMRC. Once this deadline is passed, Company can normally consider their self-assessment for the accounting period as final. Remember, once the deadline is, it's not forever. There's a deadline till when you can do the assessment. After that, your self-assessment is taken as final. Now, HMRC can demand that the company produces any of the following: document, accounts, other item particulars, full answers to specific questions. Now, remember, information that is requested should be limited to that connected with the return. Company has 30 days to comply with the request. Any appeal can be made against the request. Compliance check ends when the HMRC gives written notice that it has been completed. Notice will state the outcome of the compliance check and any HMRC amendments to the self-assessment. Company has 30 days to appeal in writing against HMRC's amendment. So these are basically rules. You can just go through it. That's why I'm going a little quicker. Not so much of what do I say? Calculation required or any questions required. So that's why there are just some points. Now, HMRC has the capacity to raise additional assessment, which is known as discovery assessment. These are the key points. Okay. See, compliance check is something normal. Normally, it begins within 12 months of the actual submission date. But there is a discovery assessment that can arise at a later date because they feel that you are hiding something. They want to prevent the loss of corporation tax. So this discovery assessment is restricted where a self-assessment return has already been made. Unless the loss of corporation tax was brought about carelessly or deliberately by the company, discovery assessment cannot be raised where full disclosure was made in the return. That means if you are making full disclosure, you can't make a discovery assessment, even if this is found to be inaccurate. Now, HMRC will only accept that full disclosure has been made if any contentious items has been clearly brought to his attention, let's say in a covering letter. Therefore, only a company that makes full disclosure in the self-assessment tax return has absolute finality 12 months after the actual submission date. That means whoever makes the disclosure, only after 12 months from the actual submission date, only their account will be final. That means no discovery assessment after that. Now, time limit is there for making discovery assessment. Basic time limit is 4 years, careless error 6 years, and for deliberate error is 20 years. This is the time from the end of the accounting period. Okay. A company may appeal against a discovery assessment. You can even appeal against this discovery assessment saying you don't want. Now, penalties. In addition to the interest for the late payment of tax, HMRC can impose some penalties also. Standard penalty. Basically, HMRC has standardized these penalties across the taxes for the submission of incorrect returns and failure to notify liability to tax. The penalty is calculated as a percentage of potential lost revenue. So the percentage charge can be reduced where taxpayers are making a disclosure and they cooperate with HMRC to establish the amount of tax unpaid. If they are cooperating for helping HMRC to establish the amount of tax unpaid, your percentage of penalty will reduce. So these are some other penalties. Now, late filing of corporation tax return. If it's within 3 months, fixed penalty is 100. If it's more than 3 months, fixed penalty increased to 200. Additional penalties. If it's 6 to 12 months, additional 10% of tax outstanding after the filing date. See, this additional means 100, 200, additional 10%. More than 12 months, additional penalty increased to 20%. Keeps on adding with the previous ones. Fixed penalties rise to 500 and 1000 if you are persistently filing late. That means return for 2 preceding periods also late. Failure to keep the required records up to 3000 per accounting period. So know the offense and know the penalty with the type of offense. Now let us summarize this lecture. So we started with accounting period saying it cannot exceed 12 months. And we calculated liability, the due date of payment, normal due date, that is 9 months, 1 day, quarterly installments for big companies, group pay arrangements where it saves interest, one group pays on behalf of the other group, notification of chargeability, you have to, and the company tax return submission dates, penalties for late filing, amendments to returns, compliance checks, discovery assessment, information inspection power, appeal, records, incorrect returns, under assessment. All these things we went through. So these are the administration part. You have to know the administration part, especially it might come under a ethics question, right? Ethical question. So that's it for watching. Thank you for watching, and I shall see you in lecture 18 with the continuation of corporation tax with some more advanced topics there. And make sure that you watch this, since this is the first lecture of corporation tax. This is like your basic foundation of corporation tax. With this, you can build up your and you can enhance your knowledge of corporation tax. So I shall see you in the next lecture with some more questions and more topics. Until then, keep watching and do watch my previous lectures as well under the ATX playlist. Thank you.